Here is a full beginner's guide to learn the Forex market in 2025. The first thing we need to speak is what is trading. Trading is literally one of the oldest things human beings have ever done. It goes way back, even before money was a thing. Imagine this. You live in a small village. You've got chickens and I've got potatoes. I need eggs. You need food. So we swap. That's a trade. I give you something you want more than what you gave me. You win. I win. That's the core of trading. Exchanging something of value for something you value even more. Fast forward to modern times. We have replaced chickens and potatoes with dollars, euros, stock, cryptos, and obviously commodities. But guess what? The principle hasn't changed. It's still the same. When you trade today, you're still trying to exchange something at the right time so that later it's worth way more money. Think about when people buy watches, this one, or even a luxury car, or maybe a house. Sometimes it's not just because they need it, it's because they believe the value might go up. They are thinking, I can sell it later for more and obviously make money. That mindset, that's trading. It's not about luck, it's about timing, value, and understanding how things move in price. Let's move into what the video is really about. Forex trading. Forex stands for foreign exchange. It's the global marketplace where people trade currencies like the euro, the dollar, the pound, the yen, and so on. Let me make it super simple. Have you ever traveled to another country? Let's say you live in Europe and you fly to the US. You go to a currency exchange and trade 1,000 euro for dollars. At the moment, let's say the rate is 1 euro equal $1.05. So you get $1,050. You spend a week in the US, but you don't use the money. When you fly back home, you go to the same exchange to swap your dollars back to euros. But this time, the rate changed. Now it's 1 euro for $1.10. You exchange your $1,050 and now you get back around 950 euros. You just lost money because the exchange rate moved while you were on vacation. Now imagine the opposite happened. You traded your euros for dollars at 1.05 and a week later the rate drops to 1 euro equal $1. Now you swap your 1,050 bucks and you get back 1,050 euros. You gain money without doing anything except holding the dollars at the right time. That's basically Forex trading. You are not investing a business or buying a product. You are just trading the price of one currency against another one. And you don't need to be at the airport or holding physical cash. This is all done online through platforms and brokerage. You buy or sell based on whether you think a currency is going to get stronger or weaker. And because the Forex market moves every single second, there are opportunities to make profit every single day. Now, let's talk about how this actually works, because this is where most beginners get confused. In Forex, you are always trading currency pairs. That means you are trading one currency against another one. Let's take Euro versus USD. We will call it Euro USD as an example. That's the Euro against the dollar. If you are buying Euro USD, it means you think the Euro is going to get stronger compared to the dollar. If the Euro rises and the dollar gets weaker, you make money. If you sell Euro USD, it means you think the Euro will drop in value and the dollar will rise. If that happens, you make money again, this time from the price going down. Here is a simple breakdown for you to understand. Let's say Euro USD is at 1.1. That means 1 euro equals $1.10. You think the euro will rise, so you buy. Later, the price goes to 1.15. Now each euro is worth more dollars. You close the trade and cash out the profit. That's a win. But let's take the opposite. You see a bad news in Europe, maybe a crisis or inflation or even economy slow down. You believe that the euro is about to drop. So what do? You don't buy Euro USD, you sell it. Later on, the price dropped from 1.1 to 1.05 and you profit again because you were right about the direction. The beauty of Forex is this. You can make money when the market goes up and when the market goes down, as long as you predict the move correctly. And no, you are not physically buying euros or holding cash in drawer. You are trading price movement on chart using a broker on a platform, and all of this by doing your own analysis. It's all digital, and so when you understand how currencies move based on news, politics, interest rates, inflation, and even emotion, you can start playing the big boy game. But here is the thing, you are not the only one playing. In fact, you are just a tiny piece of a massive machine, because behind every price movement, behind every spike or drop on the chart, there is someone or something pushing it. So before you place your first trade, you need to understand who you are up against. Let's get this straight. When you are trading Forex, you are not just clicking button on a chart. You are stepping into a multi-trillion-dollar arena. And the people moving to market, they are not amateurs. And at the top, you've got central banks like the Fed or the ECB, setting interest rate, printing money, and basically controlling the game. When they speak, the market moves. Then comes the commercial banks. JP Morgan, Goldman Sachs, moving billions every single day because they are exchanging currencies for governments, corporations, and big funds. You have also another one, very interesting, the market makers. They are the middlemen. They provide the price you see on your screen, making sure trades go through instantly and profit from the spread. Next up, hedge funds and institutional traders. These are the sharks. They trade in the millions, backed by teams of analysts, and when they move, the whole market shifts. Then you've got big corporations and government who need to move money across borders, not to speculate, just to operate. But their volume is so big that it still affects the price. And finally, there are us, the retail trader. We make up around 5 to 10% of the entire market. We don't move it, we simply follow it. So remember this, you are playing in a game dominated by giants. Your job, don't fight the wave, learn how to ride it. You're not gonna be stronger than the market. Just be his friend and follow the trend. So now that you understand what is Forex, how buying and selling works, and who's moving to the market, why would you go for the Forex markets? Because there are so many options out here, stocks, crypto, real estate. So why would anyone choose to trade the Forex? Here is why. It's not a hype and it's purely a fact. The first thing is that it's the biggest market in the world. Forex is the most liquid market on the planet. Over $7 trillion is traded every single day. That means there is always someone on the other side of your trade. No waiting, no delays, just an instant execution. 24 hours a day, 5 days a week. The market doesn't sleep. You can trade from London, Dubai, or even a beach in Bali. It's always on. The second thing why it's good is you can trade on both directions. Unlike stocks, where most people only make money when price goes up, in Forex, you can profit even when the market goes up or down. Buy when you expect strength and sell when you expect weaknesses from the market. As long as you are right about the direction, you can get paid either way. The third thing is that you don't need a huge account to start. With leverage trading, you don't need tens of thousands of dollars or millions. You can start with a few hundreds or even less and still take real position in the market. Now let's be clear, leverage is powerful but also dangerous at the same time. We will talk about it later, but the key point is Forex gives access. Anyone can start learning to game. And finally, the fourth reason, you are trading the world. This isn't betting on a single company or a project. You are trading the entire countries, their economy, their interest rate, their political decision. It's not about a hype, it's about a macro power. And that's what makes Forex one of the most logical, strategic, and real world market out here. And you know what, after thinking it, there is another thing. Learning to Forex is creating a skill in global. The skill you learn from trading Forex, chart reading, price action, risk management, psychology, they are transferable to any other market. Crypto, stocks, indexes, and commodities. Once you learn how money moves, you can apply it in anywhere in the world. You will never be stuck. So if I just sum up to you why you should be trading into Forex, simply because it's liquid, it's global, flexible, it runs 24/5, and if you're serious and disciplined, it can be the ultimate financial playground. It's not easy, don't get me wrong, but if it was, everyone would be rich. This is the game, and once you learn the rule, you stop watching the others win, and you start making your own move. Alright, now that you understand how the market works, let's talk about the tools. Because if you're going to trade, you need the right gear. Just like a boxer needs gloves or a chief needs a kitchen, a trader needs to have the proper setup. Let's break it down. First, you need a place to analyze the market. That's where TradingView comes in. TradingView is a charting platform. It's where you look at the charts, study the price movement, draw zones, mark entries, set alerts, and basically do all of your technical analysis. It's basically the control center for your trading brain. You can see the live price movements, switch between time frames, compare currencies, and even share ideas or what other traders are thinking about. By the way, it's very important for you to understand it's not a brokerage. You don't place trades directly on TradingView, okay? It's a visual tool to help you to understand where the market is and where it might go. If you're serious about trading, you need to get comfortable using TradingView. It's the best tool. And the coolest thing is that's free, okay? There is a free version of it. Once you go deeper, you can upgrade for more tools. But even with the free one, you've got more than enough to get going. There is a link in the description. I mentioned a brokerage, but what's that? That's the last piece of the puzzle. A broker is the platform that actually connects you to the Forex market. It's where you place your trades, manage your position, and handle your money. Think of it like this. TradingView is your radar, okay? It's where you analyze the market. Then your broker is your weapon. Okay, it's where you will place the order. Now, a lot of you are telling me, okay, but I don't understand. There is MetaTrader 4. MetaTrader 4 is the platform. So basically, you have TradingView, which is a tool to chart. Then you want to make a trade. So you need to create an account on a brokerage. And that brokerage will give you access to the platform MT4 where you can execute your trade live. There are tons of brokers out there, but let me save you some time. FX Giants for me is one of the one that I personally recommend, because when you're trading, every pip matters, and FX Giants offers some of the tightest spreads I have seen, especially on major pair like Euro USD or gold. That means more profit potential, less cost per trade. The platform is clean, fast and secure. No slippage, nowhere delays, and when you want to withdraw profit, it's smooth. Whether you are using MT4 on mobile or desktop, it just works. Now, here's the best part. If you use the partnership link just below, you will get access to a deposit bonus up to 100%. That means if you deposit $500 on your account, you can instantly start with 1,000. Even if you put 1,000, you're going to have 2,000. You're literally doubling your capital from day one, which gives you more flexibility, more margin, and more opportunity to grow faster. Of course, the bonus isn't a free giveaway. It's designed to boost your margin, not just hand out of cash. But obviously, in case you're using it the right way with the right management, it's a powerful head start. So if you're ready to take trading seriously, open an account on FX Giant with the link below, use the partnership link, and claim your bonus and get started trading straight away. Now, if we sum up this, to trade the Forex market, you need two stuff: a charting platform to study the market like TradingView, and obviously a broker to take your trade, and I highly recommend FX Giants. Get familiar with both, because once your tools are sharp, your tradings become intentional. Now that I explained you everything about basic, let's go and let me show you how to analyze the market, how my strategy works, and how you guys can learn my blueprint for 100% free. And let me show you how you can learn my blueprint, how you can discover my strategy that is simply based on supply and demand, and that helped me to make over $40 million. All right, so now you know how to place a trade. You understand buy versus sell, how to set up your stop loss, your take profit. You have seen how it works in real time. But before you go risking real money with any strategy, there is one thing every smart trader does first, and that's what I would recommend to you. It's simply backtesting, because trading isn't just about clicking buttons. It's about having a plan and proving that plan works. Let me explain. Backtesting is when you take a strategy and you test it on past charts to see if you would have actually made money. Instead of trading live and hoping for the best, you scroll back in time and ask, if I follow these rules 100 times, what would have happened? You're basically collecting the data, wins, losses, success rate, drawdown, all of it. If it works historically, it gives you confidence to use it going forward. If it doesn't, you just adjust and improve, or just ditch it. This is how real traders build an edge. They don't just trade, they backtest, refine, and then go live. Let's go on TradingView so I can show you how it works. So here we are on the computer. Here are the chart, and what I want you to understand is that here with TradingView, I will show you the strategy step by step, but also you're gonna understand how to use this amazing tool. So there is no drawings. I remove all of them. I can even remove the indicator. That's basically your chart. I'm gonna explain you what is a green chart, what is a red chart. I'm literally gonna go through everything for you to understand. So the first thing that you need to understand is obviously if it's green, it's going up. If it's a red candle, it's going down. We will talk about candles a bit later on. The first thing is that you need to understand that when you're analyzing a market, you need to compare this to the real daily life. So what's going on? What's going on? The first thing is to know, is the trend bullish or is the trend bearish? In case the trend is bullish, it means it's going up. Okay, it's like the animal, the bull, it's going up. And in case it's bearish, it means it's going down. And the first thing we want to know is the market going up, so bullish, or if the market is going down, bearish. And it's the exact same thing. Like if every day when you wake up, you need to go to your job. And in order to go to your job, you need to know the direction to go there. What's the road? And if you don't know the road, you will never know where the final destination is. Here, it's exactly the same thing with the market. You need to know where is the market going. Is it going up or down? And in order to have a good understanding of the market, I always recommend people to go on a higher time frame. You see a lot of people going here. So here is where you choose where each candlesticks represent what. So here in the 1 minute time frame, every candle represents the fluctuation of the market on 1 minute. You know, here if I go on the 10 minute, every candles represent 10 minutes. So each candle like this is 10 candle of 1 minute. You know, if I go on the 1 hour, that means that's the movement for the last 1 hour. And obviously inside you have 6 candle of 10 minutes and 60 candle of 1 minute. But yeah, that's just for you to understand. So I always go on the weekly time frame, try to see what's going on. So what we can see right now is that the market is going up. Now you're gonna say, no, but Switzy, look, it was going up, then it was ranging, then it went down, and now it's going up. Yeah, but we are going on the weekly time frame on purpose, because if you think about this, look, if I take here the lower low, this is since the beginning of the year, since the beginning of 2025. So for the last 6 months, almost 7 months right now, 7 months, the market has been going up with Euro USD. So we're currently in a bullish trend. Okay, this is where we're gonna be focusing right now. So if we look at the market right now, we know it's bullish. So we can even try to draw a kind of trend, you know, that every time it touch, it goes back up, just to kind of have, you see, that's a kind of like the funnel we're going. It touch, reject, touch, reject, get closer, reject. That's basically the kind of like funnels we have. That's the first thing. The first thing is to know where is the trend going, basically. Then once you understood that it's going up, because before like the market was going down, you know, then we had like the break of the structure, you know, once it break. Here it's a perfect example, because look, it was going down every time it was touching, going down. And those points are very powerful. I'm gonna put them in orange. By the way, guys, if there is something that is not clear, just feel free to ask in the comment section and I will gladly reply. Boom, boom, here it touched. Where is the line not black? I prefer when the line is black around. Yeah, it looks better. Sorry, I have some ADHD. Boom, you see every time it touched. And why we go on the weekly, because we know that on the long run, every single time it's gonna hit it, it's gonna be a solid entry for us. So here, touch, rejected, got closer, rejected, here, touch, rejected, touched, then broke it. And because we know it's a solid point, is that we know when it's gonna go back and try to retest the trend, it's not gonna break it, because weekly trends don't just break like that, you know. It's something that is for the long term. So obviously rejected here, then boom, then here got rejected twice. Okay, then we got it once here. Okay, then got it here. Okay, and now we have nothing, but next time it will hit that zone or something towards here, it will be a solid buy entry. And as you can see, when we have a bearish trend, so the market is going down, selling is very safe. Why? Is because look, even if you get a bad entry, you know, so I'm gonna go here and you can have a brush. Let's say you get here into like a sell position, then the market goes up, as you can see, so you're in losses, but then it will go back. So selling into a bearish position, so trend going down, is not risky. Same when you are buying in a bull trend. So you see here, you buy, you got lucky, here you got lucky, here hits a trend. Let's say you bought, Okay, it goes down, but after overall it goes back up, you know. Even here, if you buy here, it's okay, it might go back to the trend, then it will go back up. So it's very important to understand that we're usually trying to buy into a bullish trend and to sell into a bearish trend in order to optimize the risk. Now, obviously, when we have good entries hitting like the trend lines, we are then getting into a short position. By the way, for you who don't know, long position, okay, I will maybe just write it so it's easier for you. Long equal buy position and short equal a sell position, and bearish equal like a down trend, and bullish equal an uptrend. Okay, so you can go and take a screenshot so you can remember about this. Okay, now the first part of the job is done. It's literally very simple. We went on the weekly time frame, we tried to find what was the previous trend and what is the current trend. So right now Euro USD is going all the way up. We have a bullish trend. Then after, it's like a surgery. We're going to a deeper level. We're going to the daily time frame. Okay, so we're gonna go on the daily chart. Now, as you guys know, every chart represents a week. And here, when we're gonna go, every chart represents a daily movement. Okay, so that's what we have right now. Okay, and what we do is at that point we're gonna instantly draw to major resistance and to major support. Now you're telling me, but what's major resistance? I usually hear resistance and support. Yes, but major resistance is the highest resistance that you had till now, and major support is the lowest support that you had in your period. So right now my lowest period is right here, okay, and so that's my major support and that's my major resistance. So I'm just gonna write it for you. So major supports, okay, and major resistance. Okay, boom, that's here. That's our key stuff. Then we need to look at the intra resistance and intra support. So we're looking at the key levels. We kind of had one, which is here. You can back test. Yeah, looks solid. That's basically the intra. So that's gonna be the intra. Let me explain you why. Because as you need to understand, if I take the example of a resistance and support, we're gonna go here, rectangle, you know, let's say this is my resistance, okay, and this is my support. There is a 20-80% rule. This in green. I'm gonna put this in green too. I made this one shorter. Okay, so it's a bit similar. Okay, and then we have the rest like this. Boom, boom, boom. So this one is my resistance, the black line, okay, and that's my support. This is my resistance, this is my support. Now what you need to understand is that in the market we are only trading next to a resistance or next to a support. Why? Simply because we are applying one simple thing that is called buy low and sell high. As I told you during the intro, a lot of variables are into the market. We are not leading to a market. We are literally following all the biggest players. So when someone is buying and like putting like a buying pressure, we're gonna follow the buying pressure. When they're doing like a pressure, like a short pressure, okay, it means the market is gonna go down. We're gonna follow these trends. And basically resistance are key levels where when the market goes, we can't break it, then it goes back in the middle again. Here it go back. Like the example that I like to give is, imagine the resistance is your north coast and your support is your south coast, and in the middle we have all the big players, we have all the shark. You know that a shark, he can go close to a coast, but he can't go beyond the coast because he doesn't know how to walk. Like, he can't be like walking there, he can't breathe, you know. So obviously he can't break it. And here is the same thing. Like, in the middle of the ocean, they can do whatever. If they want to go a bit closer to the coast, they can. But if they want to go back directly, they can. They do whatever they want when they're in the middle of the market. And that's why it's very important for you to understand that the middle of the market literally represents 80%, okay? And while your support, when we're close to it, that represents 10% of the market. And when you are close to your resistance, it's also close. So we are only able technically to trade 20% of the time, and those 20% of the time areas is when we are close to a resistance or a support. So I'm gonna show you, we're in the middle, we don't control nothing. They want to go up, they go up. They want to go down, suddenly they go. They want to go up, they go. They want to stagnate, they can go however they want. But once they get close to a support, they can't break it. So that's when we position ourselves into a buy. Then they go up, then they chill, they do whatever they want, they swim, they play with the stupid traders. Then, oh, they got here. Here we sell. Then bam, it drop. It go back here. They can't break it. Then we buy. And that's how we're gonna be trading. It's basically buying low, we buy low, and we sell high. Same thing with the classical world, you know. That's why I always tell you, I give you example to know the trend is like going to your job. You need the road, resistance, support are like the coast, the middle of the ocean is the market, and we have shark playing against us. It's like an iPhone. Let's say I tell you this iPhone, which is an iPhone like 15 Pro Max, I tell you I'm selling it for $300. Will you buy it? Of course, because it's cheap. It's cheap for $300, and you will go and sell it for like $800, $900, you know. You will make money. Here it's the same thing. If the market, I tell you now, this iPhone I'm selling for 10,000, you will never buy it. But imagine if you could bet on the price that, okay, this iPhone you're telling me it costs 10K. Now, it's not sustainable. Maybe it's gonna work this for a day or two, then it's gonna drop back to $2,000. And now this one became an intra because it's no longer a resistance. Now this is the resistance and this is the support. You understand? So yeah, that's basically why I wanted to show you and explain you the entire process. So if we're looking now at Euro USD, what we can say is that, look, every time we are, so it's very important for you to understand that. Now I'm gonna delete this now that you understand, just to make the chart cleaner. Many people love to have like a shit ton of stuff. I personally don't like. The less I have on my chart, the happier I am. What we can do is that, imagine we were back in the days here, you know. How can I take it? Let's say, for example, from here. That's a backtesting function that we will be talking after. But basically, here I had no major resistance, you know. And once, I'm gonna just speed it up a bit. Perfect. You see, once it hit the trend, we have no resistance. But that can be, you can do, because you have nothing, and the space there, you know, it's not gonna be touched above. So what you can do is, once the market hits, you can put your resistance at the level of the candle. Now it's very important for us to put, and you will see that I always do this, I put at the level of the candle. I never put it at the highest high, because I also need to explain you how candles works. Candles are very important. They are very powerful. They are giving us many information for us to know what's going on into the market. So if I just show you how it works, so at least all of this is done. So a candle, initially how it works, it's very basic. So let's say it's opening at, wait, I'm gonna do something open at this price. Let's say this is $100. Okay, I'm gonna put $100 USD. That's when it opens. Then at the end of today, maybe it will go back up and it will close at, I don't know, let's say $200 to make it easy for you. 200 USD. Okay, so obviously we higher. Now maybe that's during a day. Okay, that's the fluctuation during a day. But maybe, so if that just happened, you know, so it went from 100 to 200, then we would have literally a green candle like this. Boom. Open at this price, 100, close at 200. Now let's say there is another day, okay? It goes from 200 and it goes back to 100, okay? The day after, that's day 1, that's day 2. Then we won't have a green candle, we will have a red candle. And this red candle, yeah, is just showing us it opened here at 200, closed at 200. But you probably realize that candles, they have some stuff like these big shadows. We call these wicks, okay? So I'm gonna try to move it the right way. Yeah, perfect. Okay, that's why I hate playing here. I should have just done. Okay, perfect. So they have wicks. Wicks are showing like the extreme level that has been reached during the time frame of the candle. So let's say, for example, here, boom, I'm gonna put it in black, and that I'm gonna put it in black too. So let's say during today the candle opened $100, it closed at 200. Yes, but that's during 24 hours. Maybe during these 24 hours the market kept going up. It went maybe all the way up to $300, you know, 300 USD. It went all the way up to 300 USD, then drop a bit. We had a bad news, then it dropped. Maybe it dropped even more after, and it dropped to during the same day. There is a lot of volatility on the Forex, you know it. It went to $50, and then then it went back up. So imagine the candle open, it started going up, it goes to 150, then maybe it dropped because of bad news, dropped to 50, then good news, then it goes all the way up to 300 and then close at the level. And that's why we have those wicks. Those wicks are basically showing us the higher high, so the highest level reached during the time frame of the candle, and the lowest low, the lowest level that has been reached by the candle during that day. And it's very important because that's gonna give us some information. Now let's say we have another candle which is red. It means it opened at $200, maybe close at the level of 150, you know. Maybe there is no lower shadow, maybe there is only a higher shadow. So what does it mean? It means that the candle opened at $200, dropped to 100, but at some point during today, because you see the daily candle, maybe it's like the first 4 hours, it was going up to $300, then dropped and didn't drop below 100. Then after, the day after the new candle, it will open at the level of closing, and maybe it will go back up, and we will have like a green candle like this, you know, with a lower shadow like this. And now that you understand candlesticks are extremely powerful because they are giving indication about what's going on with the market. To make it very short, because I don't want neither this video to last like, I don't know, like 2 hours, it's very easy to understand what they are telling us. They have a pivot function. So now a lot of people like to talk about the candlesticks that they all have like 1,000 way of name. For me, if you're a trader and you're black, white, Chinese, from Australia, no matter what your ethnicity, if you have the same function at the end of the day, you are a trader. Here it's exactly the same. Why would I call a candlestick that looks different with a different name in case it has the same function? So there is 3 main candles, okay, no matter the color right now, but basically they have a really small body, okay, and a long upper shadow. Then we have this one with just the upper shadow, boom, and then we had this and we have the lower shadow. So this candle on the paper is called a doji candle, okay. This one is called, oh, I'm gonna start with this one because it's very much sense, a hammer, okay. And this one has 2 names. It's either called an inverted hammer, or a shooting star. That's the 3 type of candle. But honestly, those 3 candles, they all have the same function. They have the pivot function. Now you're probably wondering, what's the pivot function? Don't worry, Habibi, don't worry. We're going straight to it, okay? The pivot function of this candle is very unique and very simple. Basically, what happened is that once we have one of those candles, I'm gonna delete the other ones because you understood that they all have the same job. So if you see one, it's gonna be the same as if you see the other one. They are switching to trend. If the market is going up, yeah, after this candle is gonna go down, okay. They have to pivot. They pivot to trend. Now at the opposite, in case it's going down after this candle, it's going up, pivot function, it's switching to trend. Now where do we use these candles? We're using them next to our resistance and support. So let's say I have my resistance level. I'm gonna draw it like this, okay. That's my resistance. If, first information, I'm near to a resistance, it means that the price is expensive, then the price is gonna go down. That's the first thing, first information. Then second information that you have, and you will understand that that's the whole point of my strategy. I'm spoiling you, but basically it's a confluence. We're adding as many information as we can in order to have a strong and powerful trade. So here I have my resistance, plus what do we see? We have these beautiful doji candles. So the market was going up, it hit the doji candle. After the doji candle, extending the trend, so it's gonna go down. So now we have 2 information, resistance plus the pivot function of the doji candle. But in case we had the doji candle, it's even more powerful. We have a 3rd information, which is very insane. And a lot of people don't understand. And again, I'm gonna show you that it also applies on your daily life, how it works on the daily basis. So what's happening here is we can see that the resistance, okay, is not broken by the body of the candle, okay, the candle is not breaking it, it's only the wicks, the shadows that are breaking it. What does it mean? It means that during the time frame of the candle, the market tried to break the resistance, didn't manage to break the resistance and close under the resistance. Let me give you an example in the real life. Let's say you and me are fighting right now, okay? I come to you, I punch you once, you laugh at me. What do I try? I try to punch you twice harder, 3 times harder, 5 times. I try to give you kicks. I put all my energy, and that's basically what the market is doing. The market is putting all its energy in order to break it, but it doesn't go through. It doesn't break it. So what's happening? It's closing under. Okay, the market, you are stronger, you win, I stop. Here is the same thing in life. What will I do? I will try, put all my energy to knock you out, and you are laughing at me. So what do? Okay, bro, you won, and I go back. I came so confident, I lost, and I'm going back like a loser. Here is exactly the same thing with the market. During the time frame of the candle, the market tried to break the resistance, didn't manage to do it. So what we know is that we have a candle rejection. When you have a wick breaking the resistance or the support, in our case now a resistance, but it didn't go through, it means that we have a candle rejection. So with a doji candle like this, we have the resistance, the pivot function of the candle, and the third information, more importantly, the candle rejection, meaning it broke the thing, but it didn't manage to be successful. Now we can have the same thing with the support. Obviously, you can call it like a hammer, doji candle, I don't care. Here also same thing. We had the support, meaning the price is very cheap, it's gonna go up. Secondly, we have the hammer, sorry, and thirdly, we have the candle rejection. Boom, boom. Now let's go back to the current chart to have a good understanding. So if you look at this, you can see that here every time we have candle rejection telling us. Obviously, this major support can be switched, because when the market go back to this level here, we can just do a translation of the support, because we know anyway that this entire area from here till here, yeah, is not gonna be broken because it's a weekly candle. There is no way that a new trend is gonna be broken. So our previous support, we're just doing the translation, you can see, from being here to, you do it all the way from the trend, boom. And if you arrive to that level, what do we see? We see something very interesting. We have what? We have one, the trend being hit. The trend being hit is a very strong indication for us, telling us that yes, it's a weekly trend, it's a higher time frame, we can get into a buy position. Second information, what we can say is that the support is here. The support is basically here. That's the main information, number two. And now, before going to the candlesticks, I want to explain you that when you have a support and a trend crossing each other like this, it's called a double bottom. We have two things on the bottom crossing each others, and it's giving us the third information, double bottom. So support, resistance, creating the third information, which is a double bottom. Plus, we can see here that we have a doji candle, plus if you look clearly, you can see the candle rejection. So we had 5 strong information telling us that, yo, this is a solid buy. Now, what do I like to do? I like to add one simple indicator, because this one is just to add some extra value. You know, as I say, there is no magical indicator that will tell you, okay, this is good, this works for trading, or everyone would be rich. If you had like a magical indicators that comes and tells you now buy, now sell, then everyone would be rich. Why would I be here explaining you the mind of trading, how trading works? There is no point. There is absolutely no point. And basically, I'm just gonna show you how we do this. You can go here on indicators, you put stochastic, okay, that's the one I use. Then you're gonna go here on settings, wait, double click here, and I like to put this. So you put the settings 1433. I'm not gonna go into the details why. All of this is also explained on the mind of trading, so in case you want to go, the link is in the description. Boom, here we go. We have the stochastic, you know, and the stochastic usually is very good information for us, telling us what to like to confirm all the information. But as you guys know, it's the same as support and resistance. There is few levels, and I'm gonna show you this from 0 till 20. Oh yeah, you know what? We're gonna first spend time on this. There is few levels. So there is from 0 till 20. That's the oversold area, equal it's cheap. And then you have the overbought area, which means it's expensive. Okay. Now, what do we do? Same principle that I told you. We are buying when it's cheap and we're selling when it's high. So here from 0 to 20, it means we should be close to a support. And when we're from 80 to 100, it should mean we should be near to a resistance. And we're just gonna add this information. The stochastic is not the most important thing, it's just an extra information for us. Now I'm gonna delete this. Here, because the previous trend just got broken, when it retests, okay, it's obviously not correlated, okay? But after, you will see that, look here, I'm close to my resistance, I have the candle rejection, sorry, I have the resistance, I have the trend creating the double top. It's double bottom when it's with the support, and with a double top when it's the resistance. So resistance, trend, crossing each other, double top. We have a candle rejection, no doji candle, and we have the matching, the confirmation with the stochastic that's telling us, okay, the price is very expensive, it's overbought. And look, even here, look, here I have a support, as I told you, the intra, but look, my even here, my support is matching with the stochastic. It means it's oversold, you know, so it could have been a potential buy. Here, look, how my resistance, okay, right here, it's always the same thing. You will realize I have my resistance, I have no trend, I'm just selling into bullish trend, okay, that's the first thing. But I have my resistance, I have a doji candle, I have the candle rejection, and I have the correlation with the stochastic. That makes it a solid trade. And you will see that every single time we're trading, we're literally using the same thing again and again and again and again. Now that's what you can do, and you can literally go on any other chart and do the same thing, you know. So for example, I will be closing. I was with some students, showing them the first thing. What we do, we're going to the weekly chart. We try to understand what's going on with the market. We can see that right now the market is kind of going down, okay. You will not always be necessarily able to find the trend, but here we go, we can see that it's going down. Maybe I will just readjust, yeah, like this, perfect. Then I'm going on the daily in order to find my major resistance right here and my major support, which is right here. We kind of had a kind of intra, and you can see every time we were selling here. So let me add also the stochastic here, stochastic setup. So before we had the bullish trend that got broken, so on correlation, okay. And here, look, boom, here hitting the trend, resistance, so double top, doji candle for information, no correlation with the stochastic, it's okay. You will see that in the future, drops, goes here, correlation with the stochastic, worked. Here, support, doji candle, candle rejection, correlation with the stochastic. So that's basically what we constantly do with the market. And as you can see, I'm going on a higher time frame. I'm always looking for a trade that you can get a shit ton of money. Let's say, for example, you got in here and you're just swinging to trade, and right now, yo bro, you would have catch 1,300 pips. Do you realize how much money is that? And that's with your first position, 1,300. Then imagine you would get a second entry here. Then like imagine how many entries you could have get. You don't get a lot of entries because my strategy is more like for swing trading and day trading that you can apply also on the lower time frame. You can also do like daily trend, 4 hours resistance support, and just do the shit, you know. But look at how many entries you got in. And with the indication I gave you right now on USDTHF since February, 3rd of February, there is no losing point. There is absolutely no losing point. Actually, there is here, the doji candle is too far from the support to get in. Maybe here you got into a buy. But here, obviously, that's something I'm talking about inside the 101 mentorship. But you see here, for example, you are getting into a buy, but you are getting into a buy when there is no correlation with the support, you know, in the stochastic. There is no real candle rejection here because it's closing above, so there is no information for you to get into a buy, you know. and plus it's a bearish chance that the market is going down, so it's even more risk. And basically, if you look at USDTHF, you wouldn't have lost once. And sometimes people are telling me, oh, Switzy, I wish you are giving more trades. Guys, I can't give you more trades. My strategy is damn accurate. Here on EURUSD, where you would have potentially lose is here, okay? That would have been like a losing trade. But who gives a damn? Look, 1, 2, 3, 4, 5, 6. On 6 trades, on 6 trades, you lost 1. So you won 5 times over 6, and with a positive risk management. That's not something also I've been talking. I will do another video for this. Guys, you are just printing a shit ton of cash. It's literally magical. So yeah, that's basically the entire strategy. So for those who I just show it, but I will just show again. It's very quick, but I think you need the paid version in order to be able to backtest. By the way, I also put like a partnership link in the description, so in case you want to support, I don't really need this support. It's just for you. It's gonna be cheaper by using the link. You just go here on replay, and basically you see you can just clear the chart and start and practice your strategy. You can literally choose the speed you want to use, and literally it keeps going. So guys, here was basically an entire guide of how you can be profitable as a trader in 2025, but also in 2026. This strategy is basically based on the supply and the demand, something that works on our daily life. As I told you the example with my iPhone, if something is too expensive, the price will correct and go down, and if the price is underpriced, too cheap, is gonna go back all the way up. And that's what we do usually. We're trading the market when it's too expensive, so we're shorting it, meaning that we're betting and speculating on the price going down, and when we're longing, getting into a buy position, we're speculating on the price going up. Now there is way more to learn about trading. I can teach you how to get funded and be able to learn this strategy, make it perfect 101 with me. I can also teach you how to get funded up to over $200,000 account, and that's crazy because let's be honest, if you start making 10% a month on a 200k account, that's $20,000 into your pocket. In case you are making 5%, that's still 10 grand in your pocket. So in case you want to learn more, there is a link below, okay, in the description, where you can see on my other YouTube channel the testimonies of my members who joined. Some made 50k, some made 350k, some made 5k in 2 weeks. That's on my YouTube channel, secondary to Mind of Trading. There is also the website themindofTrading.com, where there I'm explaining you more how you can get a 101 mentorship with me. I'm the only one in this industry where I'm teaching the people to learn how to invest their money, have a proper strategy that works not only for 6 months or a year. I've been using this strategy for the last 10 years. You know my story. I started trading when I was 16. Now I'm gonna be literally like 27 in a few months. It's been over 11 years that I'm doing the same thing again and again. So in case you want to learn more, there is just a link below where you can find more on Mind of Trading. Don't forget to like the video in case you like it, and subscribe for more trading videos.